Good morning and welcome to the press conference on the annual results of the Supervisory Review and Evaluation process and the supervisory priorities for 2025 to 2027. I'm Conny Lotze from ECB Communications, and here with me are Supervisory Chair Claudia Buch and Vice Chair Frank Alderson. Chair Buch will start with an introductory statement before we go to your questions. Claudia, please.
Thank you very much. Thank you very much for being here. Good morning. Let me welcome you to my first press conference as Chair of the Supervisory Board. This year's 10th anniversary of the single supervisory mechanism provides a good opportunity to reflect upon what we have achieved and what we can improve on. Over the past decade, European banking supervision has contributed to an increased resilience of European banks and thus to financial stability. The annual Supervisory Review and Evaluation process, SREP, for 2024 shows fundamentals of the banking system directly supervised by the ECB are strong. Asset quality is robust, banks have solid capital positions and good levels of profitability. European banks are a reliable source of funding and of financial services for households and firms. Looking ahead, banks will need to adapt to a changing environment. They're faced with heightened geopolitical risk, structural change, climate and environmental risk, and downside risks to the macroeconomic outlook. Strong financial and operational resilience will be key. Corporate insolvencies increased, potentially leading to higher credit risk. The public sector may have more limited capacity than in the past to buffer adverse shocks. The digitalization of finance is changing the competitive landscape. Banks must therefore remain vigilant and prudent to sustain their business and operations. Their currently good levels of profitability provide an opportunity to strengthen resilience. Against this background, the current SREP cycle has not resulted in major changes to banks' scores or overall Pillar 2 requirements in aggregate terms. Banks' individual scores and requirements take bank-specific risks into account. The supervisory priorities for the next 3 years continue to focus on macrofinancial and geopolitical risk, challenges stemming from digital transformation, and the need to remediate shortcomings, particularly related to governance and risk management. This year, we have also launched a comprehensive reform to make our supervision more efficient and effective, to address emerging risks in a more targeted way, and to simplify and reduce complexity. Let me get into a bit more detail and start with an overview of the resilience of European banks. Overall, banks have solid capital and liquidity positions, which is a significant improvement compared to 10 years ago. The aggregate CET1 ratio stood at 15.8% in the middle of this year, a slight improvement over last year. Similarly, the leverage ratio increased slightly to 5.8%. Capital headroom has remained broadly stable. 85% of institutions are expected to have capital headroom of above 200 basis points next year, and only a few of below 100 basis points. Turning to liquidity, overall liquidity conditions have remained favorable. Banks have good access to retail and wholesale funding. After the start of quantitative tightening, banks turn smoothly to the markets. The share of funding through deposits remained largely stable. Yet, some banks need to better prepare for an environment with potentially tighter liquidity conditions. This is the result of targeted reviews we have conducted on banks' funding plans, capabilities to mobilize collateral, and of their asset and liability management. Asset quality has remained strong. The non-performing loans ratio remains around 2.2%, which is close to historical lows. But there are signs of initial weakening asset quality, driven by exposures to commercial real estate and small and medium-sized enterprises, which account for around 50% of European banks' lending portfolios. Non-performing loans are on the rise from very low levels in Austria and Germany, and to a lesser extent in France. Low levels of credit risk reflect the strong fundamentals of households and firms, but also the public support during the pandemic and the energy crisis. Households benefit from strong labor markets, rising wages, and decreasing levels of indebtedness. Corporate balance sheets have remained resilient, thanks also to declining input and energy costs. But pockets of vulnerabilities are emerging, reflecting higher borrowing costs, weaker growth, and structural changes in the real economy. It's interesting to see, as you can do in this chart, that even during the pandemic, when GDP declined, corporate insolvencies fell. Since mid-2022, corporate insolvencies have been on the rise, though. Overall, bank profitability has remained strong, with a return on equity this year of around 10%. Interest rates are a main driver. The average return on equity increased from 4.5% during the low interest rate environment to 9.2% following the normalization of interest rates. Another driver, of course, of profitability is the cost-to-income ratio, which declined from 66% 4 years ago to 52% this year. And the cost of risk has remained muted. Average aggregate net interest margins have widened, as you can see here, but there are big differences across countries. The pass-through was faster in countries with floating rate contracts. In countries with fixed rate contracts, pass-through and the potential impact on borrower default and risks is more delayed. On the deposit side, shifts from demand to term deposits have so far been relatively slow. This also reflects differences in banks' pricing power across countries. Just an interesting fact is that only around 1.6% of deposits are held across borders. Banks' distribution plans foresee a relatively stable aggregate payout ratio of 49% for 2024, which is slightly less than last year. Share buybacks have become less prominent, declining from around 1/3 to 1/4 of total payouts. But of course, what matters is the future performance of banks, which will depend on the economic outlook and their resilience to adverse shocks. So distribution plans need to be aligned with sufficiently forward-looking capital plans that also consider relevant adverse scenarios. Then we come to the risk outlook and our supervisory responses. From a macroeconomic perspective, this year has been characterized by a resilient euro area economy, which is projected to grow at a rate of 0.7%. But the short and medium-term outlook remains subdued and subject to considerable uncertainty. The likelihood of tail events appears higher. Geopolitical tensions and deglobalization could push energy prices and freight costs up and disrupt global trade. These heightened geopolitical risks affect banks. Yet adverse events are often not priced in by financial markets, which can lead to an abrupt repricing of risk if such events materialize. In addition, financial sanctions and cyber attacks affect banks, including through outsourcing arrangements. And higher costs for firms would increase credit risk. Credit risk, therefore, remains a priority. Credit risk management, therefore remains a priority. Novel risks may not be captured by models based on past data. Accounting overlays can be one instrument to address risks in a forward-looking way. We therefore focus on deficiencies in IFRS accounting frameworks in terms of identifying and monitoring risks. To address weaker asset quality, we have also carried out targeted reviews on real estate and SME portfolios, and we take supervisory measures if we identify weaknesses. Moreover, to deal with heightened uncertainties, decision-making bodies in banks need reliable information. However, we identify ongoing deficiencies in risk data aggregation and reporting. This limits access of management to timely and comprehensive information, and it also increases reporting costs. We therefore encourage banks to improve their information systems. Generally, banks need to speed up their digitalization effort. The SREP scores for operational and ICT risk remain among the worst. One focus of our supervision is therefore outsourcing risk and cyber resilience. This year, we conducted a cyber resilience stress test to assess banks' ability to respond to cyber incidents. The test showed banks are prepared, but they also showed room for improvement. Moreover, and certainly not least, climate and environmental risks are increasingly relevant and continue to be a significant concern. Banks need to fully account for transition and physical risk. They have started to improve their governance and risk management frameworks, addressing our supervisory expectations. However, some banks still lack key elements to manage these risks, prompting further supervisory action. Against this background, the average overall SREP score in 2024 remains stable at 2.6. 74% of banks score the same as last year, 11% score worse, mainly because of exposure to commercial real estate and interest rate risk. 15% score better, mainly because of increased profitability. This year's SREP resulted in more binding measures to address severe weaknesses, reflecting our increased focus on remediation. In terms of quantitative requirements, overall CET capital requirements and guidance stand at 11.3% of risk-weighted assets compared to 11.2% last year. Changes in the risk profile of individual banks led to Pillar 2 add-ons addressing excessive risk due to leveraged finance for 9 banks with an average of 14 basis points add-on, covering of non-performing exposures for 18 banks, an average of 5 basis points, and they were applied to the leverage ratio requirements for 13 banks in a range of 10 to 40 basis points. Quantitative liquidity measures were issued for 4 banks and qualitative measures for 95 banks addressing deficiencies in credit risk management, internal governance, and capital adequacy. The stability of SREP scores reflects, on the one hand, an improvement in key risk indicators, but on the other hand, the high degree of uncertainty on the economic outlook. We've thus taken a number of measures to ensure that banks assess risks in a sufficiently forward-looking way, such as capital and liquidity planning based on relevant adverse scenarios, provisioning frameworks that capture novel risks, operational resilience related to cyber and outsourcing risks, and stress tests to capture geopolitical risks. And microprudential supervision needs to be complemented by a strong macroprudential frameworks. Releasable macroprudential buffers have actually increased. If you take countercyclical and systemic risk buffers together, they've increased from 0.3% in 2019 to 0.8% this year. We very much welcome this progress because it helps addressing uncertainties and risks to financial stability. Let me come to our supervisory priorities for the next 3 years. They will continue to focus on external challenges for banks while putting greater emphasis on remediation of persistent shortcomings. First, resilience to macrofinancial and geopolitical shocks requires the attention of banks' boards and senior management. Second, banks need to address shortcomings related to governance, climate-related environmental risk management, as well as risk data aggregation and reporting capabilities. And third, risks associated with digitalization, including cyber risks, require adequate safeguards. Now, just like the banks, supervisors need to respond to changes in the external environment. The SSM has become an internationally recognized supervisor delivering on its mandate. But our procedures have also become complex. The SREP reform that we announced earlier this year will make our supervision more efficient, more effective, and more intrusive. And you see the key elements here on the slide. These reforms will be fully implemented by 2026, and we will carefully monitor their impact. Let me conclude. European banks have strong fundamentals in terms of asset quality, capitalization, and profitability. This contributes to financial stability and the provision of financial services. Bank loans remain a key source of funding to the real economy, while non-bank financial intermediaries have increased in importance, as you can see on this slide here. Looking ahead, heightened uncertainty requires a high level of prudence. Robust business models of banks for the future depend on their resilience to shocks, their adaptation to the new environment, particularly digitalization, and the sound profitability that we currently see enables banks to further strengthen resilience in order to remain a reliable foundation for the real economy, including during periods of stress. We as supervisors will continue to focus on the resilience of European banks. Weakening standards of supervision would ultimately weaken banks, making it harder for them to support the real economy and to compete successfully. At the same time, we need to deliver supervision efficiently and effectively. This is the aim of the SREP reform, which will also benefit banks. But finally, we rely on the strong support from policymakers and regulators. Completing banking and capital markets union, rather than relaxing banking rules or delaying Basel III, is critical for financial stability and economic growth. And it would better prepare the system and us to cope with future shocks. Let me thank you very much for your attention, and we now look forward to your questions.
Thank you very much, Claudia. So we go to the questions. We have a lot of people online. If you would like to ask a question, please raise your hand, obviously, and also the same in the room. So I think we will start with the question in the room from here in the front row. If you can pass the microphone to Nick Comfort from Bloomberg, please.
Good morning. So 2 questions from my side. The first on efficient and effective. I was wondering, as you redeploy resources, as you focus on you yourself have spoken a lot about geopolitical risk this year. As you focus more on that, what are you focusing less on? And I ask this question also with respect to banks complaining about rising demands from supervisors. What are you giving them an easier ride on at the same time? And then another maybe little kind of a detailed question on significant risk transfers, and I mean the capital relief type. I was wondering if you could confirm that you now will be shortening the period that banks have to apply in advance to get these, why you're doing that. I assume it's because you like SRTs. And then also if you have any maybe words of warning to banks on this front. I'm thinking specifically about leverage employed to buy SRTs, and so whether risk is not actually leaving the financial system, but is getting actually more and more complicated. Thank you.
Thank you. Thank you for these very good questions, which allows me to explain a bit more what we do with the SREP reform to become more efficient and effective that I've mentioned. So first of all, I mean, very simply speaking, what it does is that we give more flexibility to the joint supervisory teams, to the supervisors, to adjust their supervisory action to the risk being faced and being most relevant for the specific bank. So We have overall risks and priorities that are being defined by the Supervisory Board, but then of course these risks, the relevance of specific risks might be very different for different types of banks. So the teams have more flexibility. It's not that they ignore certain types of risks, so this was a bit in your question, but rather say what is really relevant for this bank, what do we need to focus upon. So we have a risk tolerance framework that allows the teams to actually do this, and they can also spread out their risk assessment over a 3-year period. So we have a multi-year approach that not every risk basically needs to be looked at with the same intensity in each year for each bank. So we become more targeted. This is our role. This is also how we define good supervision. We become more targeted to the relevant risks. You also mentioned the point of, is there an ever-rising demand of supervisory requests? No, there isn't. It's the demand of supervisory requests is again linked to the risks that we see, because this is our role to keep European banks safe and stable. And if the environment changes, if climate and environmental risks are relevant, are not fully addressed by the banks, we need to react to that. If the geopolitical risk environment changes, then we need to address the risks that are relevant for the specific banks. Of course, we also need to do this in an efficient and effective way. So what we will do even more in the future is to use what we call integrated planning, that all our activities, be them horizontal across different banks or be them vertical for the specific banks, are integrated even more closely and can also inform each other so that we don't have to duplicate certain types of activities. But it's very important for us that we address the relevant risks that are there and don't lose relevant risks out of sight. And the teams have more flexibility now. By the way, what I mentioned, the risk tolerance framework, the multi-year approach has already been in place since 2023, but we are rolling it out now more forcefully, and we monitor the progress being made. As to your second question on the significant risk transfers, this is related obviously to securitization. And we generally think that securitization can be a useful instrument to move risks to the part of the financial system where they can be better borne than on banks' balance sheets. But at the same time, of course, we need to make sure that that there's no spillback effect on the banking sector. This is a bit the second part of your question. So who's financing these significant risk transfers, and could there be amplification effects in the financial system? Of course, we need to monitor this very closely. Now, within this framework that we have, and within also the regulatory framework that we have, there was actually room for improvement. And this is what you mentioned in terms of, for a given risk transfer, can we speed up the process until we approve a certain significant risk transfer? And here we've worked with the European Banking Federation to get a pilot started. Of course, we need some products that we can for which we can run the pilot. We will do this next year and then hopefully speed up our efforts to the benefit of us, because less resources will go into that in a more timely way, and also to the benefit for the industry. But let me reassure you, we will never lose resilience out of sight. This is given a certain risk that's being transferred, and we will carefully monitor also the effects on the financial system, because this is mainly about efficiency. It's not about weakening resilience.
Yeah, thank you very much. So we have another question here in the room, in the front row, Jasmin Osman from Handelsblatt, and then I will go online to Francesco Ninfol of Milano Finanza. So get ready after Jasmin, please.
I do have two questions. Question one, how exactly shall banks consider geopolitical risks? It's a very broad term, and I would like to have an idea what banks specifically should do about it. And the other question is a little bit more specific. It's on the recalibration of the SREP. Deutsche Bank, whose Pillar 2 requirement has increased, suggested that their higher Pillar 2 requirement is due to the recalibration of your SREP, and it would have nothing to do with any reassessment of the riskiness of Deutsche Bank. So is this view or description of them accurate? Can I imagine that you don't see Deutsche Bank anyhow more risky, but nevertheless the Pillar 2 requirement can increase? Thank you.
Thank you very much for the first question on geopolitical risk, which is indeed an issue about which we've been thinking hard to get to some extent a conceptual framework around it, because many people different people may have different understandings of what geopolitical risk is actually about. And what we have done is we've published our way of thinking about this in September this year, and the main idea is that geopolitical risk is not a new risk category for the banks. It's affecting the banks through credit risk, market risk, operational risk, but there's dimensions of this risk which you wouldn't cover if you wouldn't think about it in terms of the geopolitical environment. And here it's relatively broad as anything that's related to conflicts and tensions internationally. And so, as I've said, we've seen, if you think, for example, about the financial market channel, that relevant parts of geopolitical risk are not priced on markets. So this can affect banks' exposure to market risk if there's an abrupt repricing of risk. Or the second channel is through the real economy. So what if global value chains become more fragmented because of conflicts? How does that have to lead to a reassessment of credit risk? And then there's cyber risk, exposure to sanction risk, financial sanction risk. And so we basically work very closely with the banks to see whether they address these risks properly. We've also gone through our activities and see whether we are missing any of these channels. And we actually found that there's relatively little that we are missing. I mentioned the provisioning framework. I mentioned the work we're doing on cyber risk. So all this is very much related to geopolitical risk. And we're now working with the banks to see that they capture, again, risks that are relevant for the individual bank, that they capture this in their risk management. And let me say, maybe the most important aspect here is that it's really needs to be at the attention of top management of the boards, because this geopolitical risk is something which you can't, as I said, properly price. There's a lot of uncertainty, so the banks need to use scenario analysis that are relevant for their capital planning, and this is really something which needs the steering from the top. And we now look very carefully at what the banks are doing in this space. The second question was about a specific bank, and my apologies for reasons of confidentiality. I don't comment on.
You can answer it more general. So is it possible that due to recalibration? So it's okay if you answer general, if it's possible that you get a higher Pillar 2 requirement without you seeing a bank, an unspecific bank, more risky.
Again, so I don't comment on any specific bank, and we have not changed the Pillar 2 methodology, how the risks are being calculated. Actually, today we're publishing a lot of detail again about how our methodology is applied. There's one element also of our SREP reform, but this is not for this year's SREP. It's also for the next 2 years. We are currently working on the P2R, the Pillar 2 methodology, to make it even more risk-based, to make it more targeted, to simplify. But this is not for now. This has not affected the 2024 SREP cycle, but it's there will be again a pilot, a dry run next year, and then it will only be effective 1 year later. And we also aim to stabilize methodologies more, and also in order to simplify and to reduce complexity.
Thank you. So we will go online to Francesco Ninfola, and after Francesco, we will stay online and take a question from Bernd Neubacher of Finanzszene. So Francesco, please.
Thank you. Good morning. My first question is on profitability. How do you expect it to evolve in a context of lower interest rates and possibly also an increase of non-performing loans? Secondly, what are your considerations about the consolidation process ongoing in Europe? And what are the main elements that you want to ensure about the authorization process in cases, of course, like UniCredit Commerzbank and UniCredit Banco BPM? Thank you.
Thank you very much for the two questions. To your first question about profitability, so we don't have any forecast of interest rates that is underlying our assessment here. So we need to see how rates are evolving. What market analysts are saying is that, as you've seen in the presentation, we have now a higher level of net interest margins, and that it wouldn't go down to the levels that we've seen during the period of low interest rates. But as I've explained, this depends also on the pass-through into lending rates and into deposit rates. As you're rightly saying, so when it comes to credit risk, asset quality, we are, as of now, not seeing a significant deterioration of asset quality, so non-performing loans are actually at an historical low. But of course, we all need to remain vigilant as to how does the risk that we've just been talking about, how does that play out? How does the structural change in the real economy play out? So we don't really have a forecast here on bank profitability. What is our aim, and this is also part of the SREP process, is of course to make sure that banks have sustainable business models, that they have a sustainable long-run profitability. And one important factor here will also be their IT investments, their ability to compete in a world of even more digitalized finance. The second question on consolidation, and here again I need to make the statement up front that I'm not talking about individual banks that you have mentioned. Our role here is actually very clear when it comes to the approval process of qualified holdings. We have clear criteria in the legislation. What do we look at in terms of financial soundness, reputation of the buyers, and so forth. So we take generally a very neutral approach when it comes to cross-border versus domestic mergers. It's in the end, it's a decision of the stakeholders, the shareholders in the banks, how they want to respond to increasing competitive pressure. Digitalization and mergers are certainly one way to respond, but we don't have a specific preference as to how they should respond. We have a clear role given to us by the legislation. What are the indicators that we look at?
Thank you. So we go to, as I said, we stay online with Bernd Neubacher from Finanzszene, and then we go back to the room with Carlo Boffa from Politico. So Bernd, please. He's not, or is he connecting? If he's not connecting, then maybe we can try to connect him, and in the meantime go to Carlo in the room, please. Carlo Boffa from Politico.
Hi, good morning. Thanks a lot for taking my questions. I'll go to first one is that this year's cyber stress test showed that there are still many shortcomings in banks' cyber defenses. Have you taken any measure in the context of the SREP to address the shortcomings? And the second one is about Russia. So compared to when you took over in January, are you happy with the progress made by the banks that are still there in leaving the country? Thank you.
Thank you for those two questions. As regards the cyber stress test, this was, just to clarify what it was the question, how do banks respond to a hypothetical successful cyber attack? So it was about their response. And we actually found that the banks were quite well prepared. So because you mentioned the shortcomings, we always find, of course, issues that need to be addressed. But here, I think we found the banks also well prepared. My impression is that the banking industry also appreciated the consistent exercise across all the banks, from which they also learn, of course, where they stand relative to their peers. So to the extent that it doesn't violate any confidentiality requirements, of course, we also share with the banks or allow them this benchmarking. So as I said, we always, when we do these exercises, we also find issues, and we take this into consideration in the SREP process, because this is information that we need for our supervision. And as I've said, cyber resilience, digitalization, all this has been and will be a priority for the SSM also going forward. Well, it's also qualitative measures that are then being taken. So this is all factored into the current SREP. Yes. Yes, there were measures taken, appropriate. I can't give you the specifics about the specific banks, but there are appropriate measures taken, and this in many cases are qualitative measures. Yes. As regards the exposure of banks to Russia and risks arising from Russia, given the tragedy of the situation, I'm a little bit hesitant to talk about happiness in that context. So I mean, what was done in the SSM after the Russian invasion into Ukraine was to take stock of the exposures of European banks, which were limited in absolute terms. But of course, there was exposure to financial sanction risk, and this, we're not the sanction authority, but of course, we need to take into account what are potential implications for reputation and risk management of the banks. So we've addressed this with the banks. We've asked them to downside and exit from Russia, and we see, I think the latest number we have is that the exposures have been reduced by 56%, and we're working very closely with the banks to make sure that they comply with our decisions. But again, apologies that I can't go into the specifics for individual banks. Yeah, there has been progress, and we need to see how the situation will evolve.
Thank you very much. We will try to an online. One of the online journalists again. So we will go to Reuters. Francesco Canepa, if you are online, can you please ask your question, and then we go back to the room here to Jan Marlin. Is he? He's also not getting through. Is he? Oh, he is. Francesco, no? Okay, let's go to Jan Marlin from Plato Brief in the room. Yeah.
Thank you for the opportunity. For next year, looking forward, most economists expect a lot of rate cuts. So do you see any risks connected with that for the banking sector, and how do you think it will affect the banking sector? And my second question, you mentioned the importance of completing the banking union. Do you expect some progress on EDIS, and how important is it from your supervisor's perspective? Thank you.
Thank you very much. I don't want to comment on potential rate cuts. This is not our business to do any forecasts and to consider potential scenarios. What we do, of course, is that we make sure that the bank's exposure to interest rate risk is well managed, and so we're following up very closely in case we feel that this is not being the case, but we don't do any specific forecast or analysis of where do we think interest rates could move. And I mentioned a few other points already when I discussed profitability impacts. As to the second question on the banking union, I'm not sure whether I should also comment or to make any forecasts about the likelihood of potential dossiers to be followed through. But clearly, EDIS, European Deposit Insurance, is very important for supervisors. So we have, basically we have an incomplete banking union. So we have the first pillar. I've described the successes that have been made, the achievements. We have, and I'll come to that in a second, we have the second pillar with the resolution framework, and deposit insurance and supervision is inevitably linked together. So I think it would be good to have progress on EDIS to make sure that all deposits across the banking union have the same level of protection. So it would also promote cross-border integration, obviously, and it will also make, I think, in the end, the whole work by the Single Resolution Board less complex in dealing also with banks that are under stress. But let me mention also another very important file which is currently on the table in Brussels, which is crisis management and deposit insurance, or CMDI. So this is basically a dossier which aims to close the remaining gaps with regard to resolution. So on the one hand, to bring more banks, mid-sized banks, which can have systemic implications under resolution, and also provide the funding for this resolution through the use of deposit guarantee scheme. So it's somehow linked, but it's a separate dossier related to EDIS. And I think this is crucially important. So the more credible resolution is, the better it is for supervision, because it's setting the incentives right not to engage in risk-taking, and it's just good for the clarity of the overall framework of how we deal with banks in the going concern, but also banks that come under stress. So, and in the end also making sure that we don't have to use taxpayers' money again for banks that are under stress. So I think this is an additional benefit of the CMDI package.
Thank you very much. Okay, we'll give it another try online. There seem to have been some problems with the microphones, but we will try again with Domenico Conti of ANSA. So if you are online, can you unmute and speak up, please?
Good morning. Thank you for the opportunity. Quick question on crypto assets. As everybody, of course, has noticed, a different approach coming from the US administration. I don't know what's going to happen with the US financial authorities, but as regards the ECB supervision, is there an intention, is there an orientation towards stricter rules or looser rules regarding crypto portfolios in bank balance sheets, of course?
Thank you for that question. So I don't want to speculate on what's happening in the US, but let me say how we view crypto assets and what has also been done in Europe. So first of all, I think there's risk related to crypto assets in terms of risks that are prevalent in other financial market segments as well. So there can be excessive leverage, there can be intransparency, there can be conflicts of interest. So I think it's very important to also preventively manage and regulate these risks. And that, of course, requires first and foremost also good information about crypto markets and what is happening in this space, in particular related to leverage and, again, misaligned incentives. And I think with the MiCA regulation, Europe has done a lot to kind of move into that direction, to get better information and also to regulate to the extent necessary. And the third leg is certainly that because many of these activities are somewhat borderless, it's also important, and there have been important initiatives in the G20, in the FSB, to make sure that there's also an internationally agreed approach to this. So we need to see where this moves. We monitor this very carefully. We also monitor very carefully that the exposure of banks to crypto assets is very, very limited, and that also we deal with the competitive pressure that may arise from these markets on banks to provide crypto-related financial services. We have a very close eye on this.
Thank you.
Thank you very much. So I have a question now from Francesco Canepa in writing, because he cannot connect with us for some reason. So let me read his question out, or actually it's two questions really. The first one is, when can we expect a decision on UniCredit's request to build up its stake in Commerzbank? The second one is, can you shed light on the ECB's interpretation of the Danish compromise? Can a financial conglomerate risk-weigh all assets bought via its insurance arm? This has been described as a regulatory arbitrage that favors conglomerates.
Well, the answer to the first question is unfortunately very short, because I don't comment on individual cases, including deadlines. The second is we have the Danish compromise. We have clarified our approach in our publication on options and discretions, I think in 2016, if I'm not mistaken. And we currently have under consultation a new guide which also clarifies our approach there. In the end, it's an issue that we would also assess on a case-by-case basis for individual institutions. Do you want to do more?
Thank you very much. I don't see any questions online. Is there anybody in the room still? Because if, sorry, there is another question online. And I'm also getting another question. Oh, sorry, okay. So this is a question from also, yeah, in writing. Sorry, I don't know why people cannot log in. But this is a question from, is this a question from Roberto? Let's see, is it? Yes? I don't know. Anyway, from ANSA, I think. So let's see. I have noticed in some cases the SSM has been reducing Pillar 2 capital requirements while raising P2R leverage ratio. What is the rationale behind that? Mm-hmm. Oh, sorry, it's from Bernd Neubacher, the question. Sorry,
yeah.
It's taken here.
Well, again, there's that you're referring to individual banks. I couldn't comment on this. I mean, generally, the P2R and the P2R leverage ratio add-on have different purposes. So the P2R is basically to cover risks that are not covered or not sufficiently covered under Pillar 1, and the Pillar 2 leverage ratios add-on is about the risk of excessive leverage. And it may well be that there are cases where the risk of excessive leverage is increasing, and there's less risks of the type that have just been described that are not sufficiently accounted for in Pillar 1, where that is declining, or the other way around. So there's not a necessarily link between these two, as you've been suggesting. So this is just different assessments. We take a very detailed approach, risk by risk. We look at all the banks. We look at the different elements of the SREP process, and this can be one outcome. But again, this is not a statement about an individual bank where this may have happened.
Thank you very much. So now we do have a question online from Roberto Vozzi from Ask a News. Can you unmute, please, and ask your question? Roberto, I can hear somebody speaking, but it's not coming through here. I think you need to unmute, Roberto. Yeah, the sound's not getting through. Sorry about that. Of course, we always invite people to come in person to our press conference, which makes things a lot easier, but I understand a lot of journalists are not in Frankfurt, and it's difficult to get here. So we cannot hear Roberto, he's not getting through? Okay, we can get his question, but in the meantime, I mean, is there one last question from the room maybe? Because otherwise we can start to wrap it up. Okay. Thank you very much. Okay, we will wrap it up here. Thank you very much, Claudia. Thank you very much, Frank, for your availability. So this will conclude the press conference on the annual SREP results. Thank you very much.